Hey everyone, Marcus and Millichap has just released the 2026 Hospitality Investment Outlook. In addition to the insights this report offers on national hospitality trends, it also provides detailed analysis of 34 major metros across the country. Now, following the pandemic, the hospitality sector made strong gains in occupancy, the average daily rate, and in revenue per available room, or RevPAR. But in 2025, the momentum began to abate. The impact of uncertainty created by trade policy, enhanced immigration enforcement, and slowing job creation began to weigh on hospitality demand. And that began to restrain occupancy levels, particularly in limited service hotels. Although the average daily rate has continued to rise, RevPAR has largely flattened out. One of the other key forces impacting performance has been the addition of new supply. In 2024, about 75,000 rooms were added to inventory, and in 2025, new construction added nearly 80,000 rooms. The wave of construction impacted performance, especially in high development markets like Austin, Nashville, Salt Lake City, Phoenix, and Atlanta. On the flip side, metros that received little development like Orange County, Cleveland, San Francisco, Minneapolis, St. Louis, and Chicago generated healthy hotel demand that supported strengthening occupancy levels. The development wave is expected to peak this year with the addition of about 95,000 new keys. And those completions, together with modestly weaker demand, is expected to weigh on occupancy this year, while RevPAR remains relatively stable on a macro basis. The full service segment has outperformed the general trend, and business travel has remained healthy, which is supporting this segment. And it should sustain its outperformance of lower tier properties this year. But after this year, construction should begin to thin. The elevated cost of construction capital, as well as rising material and labor costs, have begun to restrain the construction pipeline. So as supply risks begin to abate after 2026, the market should rebalance against the modestly weaker demand. Another factor restraining new development has been the pricing recalibration of hotel properties. In many cases, hotels are trading below replacement cost, and investors are finding it more feasible to acquire assets and upgrade them rather than building new hotels. Private investors have been leading this trend, and in 2025, their share of the total hospitality sales volume reached a new high, comprising nearly 75% of the total. Cap rates on hospitality properties, both limited service and full service, nudged higher in 2025, while the cost of debt capital trended lower. That supported a 14% uptick in transaction activity last year, with the bulk of the trades under the $5 million threshold. Looking forward into 2026, the sector faces elevated uncertainty as rapid policy changes impact both leisure and business travel. If elevated fuel costs are sustained into the summer travel season, then hospitality demand could be impacted. But by the same token, the rising cost of air travel could influence vacation plans and shift demand to drivable local and regional vacation destinations. So while the hospitality sector does face headwinds in 2026, limitations on development will ultimately favor existing assets. And once uncertainty abates and job creation gains momentum, hospitality assets could be well positioned to outperform. But once again, capitalizing on this opportunity requires a vision for the future and the ability to look past the short-term headwinds. Investors need to consider the longer-term supply and demand fundamentals, which remain favorable. And seeing that opportunity really requires investors keep their eyes on the horizon.